The markets whisper promises, a constant hum of opportunity and risk. We hear the word undervalued so often, it can become a mere echo, a meaningless buzzword that sends us scrambling for the lowest price, the cheapest stock, without truly understanding what lies beneath. It's like searching for buried treasure with a faulty map, guided by fleeting trends and the frantic whispers of the crowd. Many are called to this pursuit, but how many truly hear the market's genuine voice, not just its clamor? Warren Buffett, a name synonymous with enduring wisdom, didn't build his legacy by chasing every passing fad. His brilliance, much like the foundational principles laid down by Benjamin Graham, the father of value investing, was in discerning true, lasting worth. It's about seeing beyond the immediate price tag to the inherent quality of a business, to understand its predictable future, and to acquire it at a fair price, not just a low one. This is the essence of the intelligent investor, to seek not just cheapness, but enduring value. Today, we're going to look past the superficial. We're moving beyond simple metrics like low price to earnings ratios. We're going to dissect the subtle, often overlooked indicators that the Oracle of Omaha uses to identify sectors poised for sustainable, long-term growth. These are the territories that often escape the frantic gaze of day traders and headline chasers, the quiet giants waiting for those with a discerning eye. This isn't about blindly following a legend. It's about understanding the disciplined, data-driven, and psychologically astute approach that underpins his success. We aim to equip you to find your own undervalued territories, to see what the masses miss. By decoding the bedrock of business fundamentals, prepare to shift your perspective. Buffett's keen eye for undervalued sectors is rooted in identifying businesses with durable competitive advantages, what he calls economic moats. These moats, whether built on brand strength, network effects, regulatory tailwinds, or cost advantages, are the bedrock of predictable earnings and long-term value. This principle aligns directly with Graham's concept of a margin of safety, ensuring that even if predictions falter, there's a buffer against permanent capital loss. Think of it like navigating a desert. While many chase the shimmering mirages of trendy, speculative stocks, Buffett studies the underlying terrain, the established routes. He seeks reliable water sources, sectors where companies possess strong moats. Consider a company with an iconic brand, one that consumers trust implicitly. This isn't just a logo, it's a deep-seated connection, a widening moat that competitors find incredibly difficult to cross. The notion that a low stock price automatically equates to a safe or good investment is a dangerous myth. These value traps can lure investors into fundamentally flawed companies. Buffett's moat analysis is the antidote, helping to distinguish genuine value from mere cheapness. He buys businesses, not just stock tickers, and the moat is a critical component of that business. To identify these moats yourself, start with a simple three-step framework. First, analyze the competitive intensity in a sector. Is it a cutthroat battle or a more stable environment? Second, assess pricing power. Can companies raise prices without alienating customers? Finally, evaluate customer loyalty and switching costs. How hard is it for customers to leave? This analytical approach empowers you to look beyond surface-level metrics and understand the true durability of a company's competitive position. Understanding the economic moat is understanding the very DNA of enduring profitability. The term undervalued often conjures images of a low price-to-earnings ratio, a simple number that many investors fixate on. But Warren Buffett's perspective is far more sophisticated. He looks beyond the immediate PD, delving into the future potential of earnings, the efficiency with which a company allocates its capital, and its return on invested capital. This nuanced view is deeply aligned with Benjamin Graham's core tenet, understanding intrinsic value, not just the fluctuating market price. Consider the historical narrative of the telecom sector. Before the dot-com bubble burst, many telecom stocks appeared remarkably cheap by conventional metrics. Yet, beneath that superficial low P lay a complex web of debt and unsustainable business models. Buffett, however, would have likely focused on the sustainability of cash flows and the burden of debt, transforming a simple valuation metric into a profound diagnostic tool. This is the difference between seeing a price and understanding the underlying business health. The inherent danger of relying solely on historical valuation ratios is the risk of falling into value traps. These are companies that appear cheap because their fundamentals are deteriorating or they face irreversible competitive disadvantages. Investing in such companies solely based on a low PE can mean buying into businesses that are permanently impaired. It's a pitfall that Buffett actively and wisely avoids by incorporating a broader analysis of the business itself. To apply this, let's simplify the concept of return on invested capital, or ROIC. By comparing the ROIC of leading companies within a sector, you can discern which ones are truly adept at allocating capital efficiently. This metric reveals which businesses generate the most profit from the money invested in them, a key indicator of the kind of companies Buffett favors. It's a window into operational excellence. The market might offer you a discounted ticket to a show that's already concluded its run. Buffett's definition definition of undervaluation, however, is about securing a seat for a long-running, profitable production. This distinction is not merely semantic, it is critical for building sustainable wealth, for investing in enduring value rather than fleeting appearances. Our minds, while powerful tools, are also prone to ingrained biases that often cloud our investment decisions. Herd mentality, the urge to follow the crowd, recency bias, where we overweight recent events, and confirmation bias, seeking information that validates our existing beliefs. These are the invisible forces that can blind us to the very sectors Buffett identifies. He, in contrast, masterfully leverages these human tendencies, often betting against the prevailing sentiment. Consider a vast flock of birds migrating. Most investors instinctively follow the flock, moving in the direction everyone else is going. Buffett, however, is like the observer who studies the underlying currents of the wind and the contours of the land, the economic fundamentals at play. He predicts where the flock should be heading, or more importantly, where they are being misled. Think back to a historical market panic, a moment of widespread fear. While the flock scattered in terror, Buffett likely saw a hidden opportunity, a sector unfairly punished by irrational sentiment. This leads us to debunk a pervasive myth that market sentiment, or the prevailing narrative, is a reliable guide to future stock performance. The truth is often the opposite. Buffett famously advocates buying when there is blood in the streets, a counterintuitive strategy that thrives on irrational fear and panic. It's in these moments of widespread pessimism that truly undervalued opportunities often lie hidden. To harness this contrarian approach, develop your own contrarian checklist. This involves actively seeking out sectors or companies that are currently out of favor, yet possess strong underlying fundamentals. It means intentionally looking for negative sentiment and then deeply scrutinizing the reasons behind it. Is the pessimism justified by fundamental decline, or is it an emotional overreaction? Your checklist becomes a disciplined filter against the noise. Ultimately, your greatest adversary in the pursuit of wealth isn't the external market. It's the reflections staring back at you from the mirror of your own biases. Buffett's enduring success is a profound testament to his ability to tame these internal forces, to understand them, and to use them as a strategic advantage in his investment journey. This framework of 8 undervalued sectors is not a capricious selection. It's a strategic distillation, derived from a meticulous analysis of industries that consistently exhibit the characteristics Warren Buffett himself favors. We're talking about sectors characterized by strong, predictable cash flow generation, requiring minimal capital expenditure to operate and grow, possessing robust pricing power, and demonstrating clear potential for long-term, secular growth. This understanding is informed by his extensive investment history and his candid public statements over decades. Let's apply this lens to a hypothetical example. Imagine a niche within the industrial sector, perhaps a specialized component manufacturer. This company might be temporarily facing headwinds, making its stock appear undervalued by superficial metrics. But a deeper, data-driven analysis would examine its industry growth rates, the stability of its competitive landscape, and the regulatory environment. We would then identify key companies within this niche that align with Buffett's criteria, those with consistent free cash flow, manageable debt levels, and stable operating margins. The hidden truth here is that the sectors Buffett watches are often those experiencing temporary challenges or are simply unglamorous, thereby overlooked by investors drawn to more speculative, high-growth narratives. The reason these opportunities are missing from many investors' radar is frequently a deficit in deep, fundamental analysis rather than an absence of genuine opportunity. The market's noise often drowns out the quiet hum of true value. To empower you to replicate this process, consider a simplified screening model. Focus on metrics like free cash flow yield, how much cash flow a company generates relative to its market price, alongside a healthy debt-to-equity ratio and stable operating margins. These indicators can help you identify potential companies within promising sectors, equipping you with a tool to discover value independently. Think of these 8 sectors not as a pre-drawn treasure map leading directly to gold. Rather, envision them as a sophisticated sonar system designed to detect the deep, resonant hum of enduring business value, a value that lies hidden beneath the cacophony of the market's surface noise. It's about listening for the fundamental strength that truly matters. The ultimate objective extends beyond merely identifying undervalued sectors. It's about weaving this profound understanding into a cohesive, enduring investment strategy, one that truly harnesses the transformative power of compounding. This principle, championed by both Buffett and Graham, is the bedrock of sustainable wealth creation. It's not about quick wins, it's about consistent, intelligent growth over time. Consider the construction of a magnificent building. Buffett's method of selecting undervalued sectors is analogous to choosing the most stable, well-engineered foundational materials. He selects businesses with inherent strength and durability. This approach ensures structural integrity and fosters long-term long-term growth, preventing the portfolio from becoming a mere flimsy facade that crumbles under pressure. The focus remains on building something substantial, something that endures. A significant psychological trap that derails many investors is the relentless urge to chase new, exciting opportunities, the pervasive fear of missing out, or FOMO. This constant distraction can severely impede the slow, steady work of long-term compounding. Buffett's extraordinary patience and unwavering conviction in his chosen sectors are crucial. It's this steadfastness that allows the magic of compounding to truly work its wonders, turning small, consistent gains into significant wealth over time. To integrate this wisdom into your own portfolio, consider a framework for allocation inspired by Graham's principles. Determine appropriate position sizing, how much capital to allocate to each identified undervalued sector. Establish clear triggers for rebalancing, ensuring your portfolio remains aligned with your long-term perspective, but without diluting truly significant opportunities. The key is to maintain discipline and a long-term vision. Buffett's focus on undervalued sectors offers more than just financial opportunities. They are profound lessons in patience, discipline, and the deep art of understanding business at its core. By adopting this discerning lens, you move beyond mere speculation and guesswork. You gain the ability to build wealth not by trying to predict the future, but by understanding the present and investing in what you know will endure. We've journeyed beyond the superficial allure of simple stock prices, peeling back the layers to understand what truly constitutes undervalued in the eyes of a master investor. We've seen how Warren Buffett's focus on sectors poised for enduring growth is deeply rooted in the analysis of economic moats, a sophisticated understanding of valuation that transcends mere numbers, and a profound grasp of behavioral finance. These aren't just abstract concepts, they are the very tools that allow for the identification of sustainable wealth-building opportunities. Recall Benjamin Graham's timeless wisdom: the investor's chief problem is likely to be his own temperament. Our exploration today has been an invitation to confront those internal challenges by recognizing our inherent biases, the herd mentality, the recency effect, and by consciously adopting Buffett's data-driven, analytical lens. You can begin to transform from a reactive participant swayed by market whims into a proactive owner of businesses with demonstrable value. This shift in perspective is fundamental. The sectors that may seem missing from your investment radar are often not hidden in some secret vault. They are frequently right before our eyes, obscured by the relentless noise of daily market fluctuations and the comfortable, yet often misleading, glow of conventional thinking. Your crucial next step is to take the analytical framework we've discussed and apply it diligently. This is your invitation to look beyond the fleeting headlines and the ephemeral hype. It's time to start seeing the enduring, intrinsic value that has consistently driven sustainable wealth creation for those who understand where to look. So, as you move forward, ask yourself this critical question: what sector, perhaps currently out of favor or simply unglamorous, possesses a robust economic moat that you can now identify using these principles? The journey to becoming a more informed, strategic, and ultimately more successful investor begins not with a grand gesture, but with that single, deeply considered question.